In the last few years, something unprecedented has been happening behind closed doors at the world's most powerful financial institutions. Central banks, the very entities that manage trillions in global reserves, have become the largest net buyers of physical gold in recorded history. In 2024 and 2025 alone, they added well over 1,000 tons combined to their vaults, with Poland, Turkey, India, and China leading the charge at levels we haven't seen in decades. Poland alone scooped up dozens of tons in early 2025. China continues its quiet, relentless accumulation. India and Turkey aren't far behind. At the very same time, these same institutions have been reducing their purchases of new US Treasuries, or in some cases, quietly trimming existing holdings. The safest asset on Earth, the one they've spent half a century telling us is indispensable, is being swapped out for the one they once dismissed as a barbarous relic. Why are the world's central banks voting with their vaults against the dollar system they helped build? That's the question almost no one in mainstream finance wants you to ask. What you don't see, what they don't want you to see, is that the real drivers are sovereign central banks. The People's Bank of China, the Central Bank of India, the Central Bank of Turkey, the National Bank of Poland. Together, the gold reserves of just these emerging market players now rival or exceed those of several G7 nations. These aren't speculative hedge funds gambling on momentum. These are the institutions that set monetary policy, defend their currencies in crises, and decide what counts as a true global reserve asset. When they move in unison, quietly, over years, you should pay attention. For 50 years after 1971, when Nixon closed the gold window, central banks pushed a simple narrative. US Treasuries are the ultimate risk-free asset. Gold is a pet rock, volatile, unproductive, a relic of a bygone era. That story was convenient while the dollar reigned unchallenged as the world's reserve currency. Governments, pension funds, and banks around the world parked trillions in treasury bonds. The US could run deficits without immediate consequence because everyone needed dollars and dollar debt. That narrative held until it didn't. The shift started slowly after the 2008 crisis, picked up speed when COVID spending exploded deficits, and then went into overdrive after 2022, when Western sanctions froze hundreds of billions in Russian reserves overnight. Suddenly, holding large treasury portfolios didn't feel quite so safe anymore. In 2024 and 2025, the pace became record-breaking. Central banks aren't just talking about diversification, they're doing it at scale, moving billions from paper promises into physical metal they can touch, audit, and if necessary, repatriate. Here's the simple truth. The old system rests on two pillars. First pillar, US Treasuries, IOUs issued by the US government. Digital entries, promises to pay in dollars, backed by the full faith and credit of a nation now carrying over $36 trillion in debt. Second pillar, physical gold, a bearer asset with no counterparty risk. No one can freeze it remotely. No one can print more of it. It has outlasted every fiat currency in history. Reserve assets are supposed to anchor a currency's credibility when trust falters. For decades, the Treasury pillar carried almost all the weight. Now, quietly, methodically, central banks are shifting weight to the gold pillar before the broader public realizes the ground is moving. That's the thesis we're going to unpack today. The world's most sophisticated monetary institutions are voting, with real money, that the old rules are breaking, and they're positioning themselves accordingly while most people are still asleep. Let's pull back the curtain on why this shift isn't just happening. It feels inevitable once you understand the mechanics. The turning point came in 2022, when Western governments froze nearly half of Russia's foreign exchange reserves overnight. Hundreds of billions in dollar and euro-denominated assets. The unspoken rule that reserve assets are politically neutral shattered. For the first time in the modern era, a major power saw its treasury holdings and dollar deposits weaponized and seized without warning. That wasn't a theoretical risk anymore. Every central bank outside the tight Western alliance took notice. If it could happen to Russia, it could happen to them. Suddenly, parking the majority of your nation's savings in assets that another government can freeze with a signature didn't look like prudent risk management. It looked like vulnerability. Now every non-aligned central bank faces a forced choice with no good options. Option 1. Keep rolling over and adding to a pile of US Treasuries that now backs a national debt exceeding $38 trillion and growing by trillions every year. These are promises from a government that has shown it will use the dollar system as leverage when it suits its interests. Option 2. Diversify into physical gold, an asset no foreign power can freeze, seize, or block remotely. The supply is finite, the demand is global, and ownership is absolute. For many central banks, especially in emerging markets, staying fully committed to ever-expanding U.S. debt has become politically untenable and financially risky. The math no longer works when trust is conditional. This isn't a coordinated conspiracy. It's a self-reinforcing chain reaction that's already underway. One major central bank slows its treasury purchases or quietly sells a portion. Yields tick higher to attract new buyers. Higher yields mean higher debt service costs for the U.S., already over $1 trillion annually and climbing. To cover rising interest and ongoing deficits, the Treasury issues even more debt. If foreign demand doesn't keep pace, yields rise further to entice domestic buyers or the Fed. A weaker dollar follows as confidence erodes. That weaker dollar makes gold relatively more attractive, accelerating diversification. More diversification means even less demand for new Treasury issuance, pushing yields higher still. We've already seen pieces of this loop in motion. Central banks added 863 tons of gold in 2025 alone. Historically elevated, geographically broad, and led by Poland's 100-ton addition and China's steady, unreported accumulation that pushed their reserves past 2,300 tons. Global gold reserves are now valued near $4 trillion and climbing fast with prices at record levels. Meanwhile, while total foreign holdings of treasuries hit a nominal peak in late 2025, the trend beneath the surface is more nuanced. Key non-aligned players like China have trimmed exposure over longer periods, and the overall foreign share of U.S. debt has stabilized or dipped relative to the explosive growth in total issuance. The appetite for absorbing endless new supply at low yields is waning. Even the Federal Reserve and U.S. Treasury are increasingly powerless to halt this without extreme measures. They could slash rates aggressively to keep yields low, but that risks reigniting inflation in an economy already sensitive to import costs. Or they could impose capital controls to trap dollars inside the system, but that would shatter the remaining trust that keeps the dollar dominant. Either choice accelerates the flight toward neutral, non-confiscable assets like gold. This is the fundamental divide between paper and reality. U.S. Treasuries are digital book entries, claims on future dollars, dependent on continued U.S. fiscal discipline, political stability, and unquestioned global trust. They carry counterparty risk, the risk that the issuer cannot or will not pay in full real terms. Physical gold is a tangible bearer asset. It has no issuer, no maturity date, no political allegiance. It has survived every empire, every currency collapse, every monetary reset in recorded history. You can audit it in a vault. You can move it on a plane if needed. Central banks know this. They've stress-tested both assets through crises. The wealth transfer this shift implies is straightforward and brutal. Those who accumulate physical gold early, before the full repricing of risk becomes obvious to markets, preserve and potentially grow real purchasing power. Those whose wealth is locked in dollar-denominated paper claims, bonds, cash savings, Pension funds heavy in treasuries face gradual erosion as the system rebalances through higher yields, inflation, or outright devaluation. Look at what the institutions themselves are doing, not what they say. Public officials and legacy media still describe treasuries as risk-free and the dollar as unchallenged. Yet the same central banks are record buyers of gold and, at best, reluctant participants in new treasury issuance. Poland publicly repatriated and expanded its holdings to 550 tons by the end of 2025, with plans for another 150. China extended its buying streak into 2026, adding quietly each month. Turkey, India, and others follow the same pattern. Actions speak louder than press releases. The old rules are dead. The post-Bretton Woods playbook, 60-40 portfolios, bonds as the safe anchor, gold as a speculative sideshow, assumed permanent dollar hegemony, and politically neutral reserves. That era has expired. We are entering a multipolar monetary order where physical gold is quietly reclaiming its ancient role as the ultimate neutral reserve in a fragmented world. The mechanics are in motion. The incentives are aligned. And once a trend like this reaches escape velocity, it doesn't reverse easily. Let's make this personal now, because this trend doesn't stay locked in central bank vaults forever. It leaks out into the real economy, into your life, often in ways that feel gradual until they don't. When foreign demand for treasuries slows, yields have to rise to attract buyers. Higher yields push up borrowing costs everywhere. Mortgage rates climb, making homes less affordable and refinancing painful. Credit card interest hits new highs. Businesses borrow less, hire less, expand less. The economy cools. At the same time, a softening dollar means everything you import costs more. Energy, food staples with global supply chains, manufactured goods, travel. Your paycheck or savings buy less at the grocery store, at the pump, on vacation. Purchasing power erodes not in a crash, but in a slow, persistent grind that compounds over years. The standard of living you've counted on quietly contracts. This feeds a vicious feedback loop that's already showing early signs. Deficits keep running at trillions a year. Structural, politically locked in. Foreign buyers pull back, unwilling to absorb endless new issuance at low yields. The Treasury has to offer higher rates to clear auctions. Interest expense on the national debt balloons, already crowding out other budget priorities. Politicians face pressure to keep rates down artificially. More Fed purchases, more monetization. That fuels inflation, which weakens the dollar further, making gold and hard assets more attractive to everyone, not just central banks. More capital flows out of dollar paper. Yields spike again to compensate. Debt service takes an even bigger bite. The cycle repeats, each iteration more intense, until something forces a reset. We've seen this movie before. The decline of the British pound as the world's reserve currency followed almost the exact pattern. After World War I, Britain was saddled with massive debt. Deficits persisted. Foreign holders grew wary. Sterling assets lost appeal. Gold began flowing out of London vaults toward more neutral or rising powers. The process dragged through the 1920s and 30s, with attempted returns to gold standards that failed. World War II accelerated it. By the 1950s, repeated sterling crises and devaluations marked the end. Reserve status didn't vanish overnight. It eroded while gold reasserted itself as the true anchor for nations hedging uncertainty. The unipolar dollar era, built on unquestioned trust and political neutrality, has ended. The world is multipolar, fragmented, with competing blocs and conditional alliances. In that environment, a neutral, finite, non-confiscable asset like physical gold naturally rises to fill the vacuum. It's not speculation. It's the same logic that governed monetary systems for centuries before 1971, now re-emerging because the conditions demand it. You're awake to this shift, while most people are still following advice calibrated for a world that no longer exists. The majority, retail investors, pension funds, even many financial advisors, are still overweight dollar-denominated bonds and cash, still treating treasuries as the ultimate safe haven. They haven't registered what the central banks are doing with their actions, not their words. But you have. You see the mechanics, the incentives, the historical precedent. That clarity gives you the chance to act on the same rationale the most sophisticated institutions are already executing, positioning yourself to preserve real wealth through the transition, rather than watching it slowly dissipate as the system rebalances. So, what does this mean for you? Practically, I'm not here to give you personalized financial advice. That's impossible in a video like this. And you should always do your own research and consult professionals who know your situation. But I can share the same basic framework that the central banks themselves are already applying at scale. The asset class they're accumulating aggressively, physical gold, has the exact characteristics they're seeking in a fragmented world. No counterparty risk, no remote confiscation, global recognition, and a supply that can't be inflated away. It's not magic, it's not a get-rich-quick scheme, and the timing of any repricing is inherently uncertain. Prices can be volatile in the short term, and there's no guarantee of profit. That said, if you're convinced by the institutional trend, the quiet vote of confidence from the world's most sophisticated reserve managers, then considering an allocation to physical gold makes logical sense as a form of monetary insurance. Principles are straightforward. Size the position according to your overall portfolio and risk tolerance. Typically a modest percentage for most people, larger if you're more concerned about systemic tail risks. Prioritize allocated physical metal you can verify and ideally take delivery of or store in secure audited private vaults outside the banking system when feasible. Paper proxies like ETFs can be convenient and liquid, but they reintroduce counterparty risk, the very thing central banks are moving away from. Use only established, reputable dealers with transparent auditing and a long track record. Avoid high-premium collectibles or anything that sounds too good to be true. This isn't about abandoning everything else or timing the top tick. It's about aligning part of your wealth with the same hard asset logic that Poland, China, Turkey, and others are executing right now, before the trend becomes consensus and the easy phase of the move is over. The data keeps coming in monthly. The trend is still accelerating as we move into 2026. New reserve updates, new repatriations, new catalysts on the horizon. The next major trigger could materialize any quarter. Another geopolitical flare-up, a failed Treasury auction that makes headlines, a visible crack in dollar confidence. If this breakdown shifted your perspective even slightly, hit the like button. It helps more people see it. Subscribe and turn on notifications if you want to keep getting clear, data-driven takes like this as the trend continues to unfold. Thanks for watching. I'll see you in the next one.